Good morning, everyone. Welcome to this update for global markets and commodities for the 21st of August. And this week, it would appear that we've got confirmation of another new bull market. As you know, we've been tracking the spectacular rise in the precious metals market since January, February. And I've been watching the energy space and expecting that we wouldn't see a great deal probably until towards the end of this year. But certainly the signs are emerging now that are looking quite positive for energy. So I want to take a good look at that this morning. Let's start with what happened during the week. The S&P index finished exactly flat on the week, fluctuated up and down a little bit within a very narrow band, but really not much happening. And so a lot of people are questioning whether this is just a consolidation before the market moves higher, or whether this is some sort of short-term top before we get a pullback. Look, I don't know the answer to that, and frankly, it doesn't really matter shorter term because we can't really play the market short term with any sort of reliability. And as investors, what you should be looking for is an approach to the market that does give you reliability and high probability. And I don't believe you can do that in the short term. A lot of the time you're just guessing. And if you happen to get it right, it's a bit more about luck than good management. There is certainly a lot of very positive signs. And so I remain quite bullish for all the reasons that I've outlined over recent weeks and months. You've just got to go with what is, and the S&P went up for 5 or 6 years. It then went sideways for 2 years, and now it's broken into a new uptrend. And whether you like it or not, that's pretty much what's happening, and that's what you should go with. But we also are seeing now a rotating leadership from the defensive stocks, consumer staples, utilities, and we're seeing a rotation into certainly technology has been very strong, but also now energy. So that's a real positive for the market. A broadening rally in the S&P is another positive for the market, and now 72% of the S&P stocks are in an uptrend. We're also seeing Germany, UK, and China markets now moving either into a breakout phase or certainly moving much more positively. So that's a real plus as well. When you stand back, though, medium term and longer, the key drivers of the US market will be particularly corporate earnings, and corporate earnings are showing signs of a little bit of improvement. It's a bit like the US economy. It's not doing anything startlingly good, but then again, it's not doing anything poor either. It's just good enough. And of course, the other driver will be Fed policy and what they do with interest rates. But look, normalization of interest rates is a topic that everyone's got a different view on. It's hard to know what the US Fed is going to do, but a rise in rates is not necessarily a bad thing for the market. That's what history would show you. And just finally on the US market, the dollar was down a little bit on the week, which certainly caused some buoyancy in our currency towards the end of the week, but it's still within an overall range. Let's take a look at the S&P market and some of the other key markets. So this is the S&P. Let me just pan back and give you sharper perspective. So massive bull run from the bottom in 2009. We then had 2 years of sideways action, looked like the market was going to roll over. We did get what turned out to be a false break of these lows. So that was the key lows that I was looking for. And if you want a more detailed look at the S&P and why you shouldn't really have any fear about being caught in the next market crash, then please go back and look at the video I did last weekend, the 14th of August, because that goes through the period 2000 and also 2008. So personally, and within my group, we did take some preliminary action when we got these breaks in January, but of course the market then turned around and went back up again, and so we basically washed out that little bit of a change we'd made in our positioning and have continued to follow the market to the upside. Now you can see that There's not a great deal of momentum in this upward move at the moment, but nevertheless, it is trending upwards, and that's basically all we need to know, really. Let's look at the DAX. So the DAX index was in a significant downtrending channel. That downtrending channel has now been broken. It's not convincing yet. I'd feel a bit more comfortable. We certainly have broken these highs through here. So we've definitely formed higher highs and higher lows. I'd feel more comfortable when we get up above here, above this peak. But you can't deny we've now got a breakout in the DAX. Let's look at the UK market. There's the FTSE. Here was the day of the Brexit vote. And just look at what's happened to the UK market since then. And it's now basically going back and almost back to its all-time highs. And certainly it is in short-term uptrend from an event that everyone said, well, you know, that's it. The UK economy's absolutely in trouble and the UK stock market will go down. And finally, let's just look at China quickly. This is the Shanghai Composite Index. A collapse from the middle of 2015. We've formed a base, and as you can see now, we're just starting to pop up above that base. So there's no denying that the Shanghai Composite Index has now made a move outside of its base. So some very, very positive signs. Just while I'm here, let's just have a quick check-in on the Australian dollar. So we're still really in this big downtrending channel. We might have made a false little break. So that downtrending channel started in April of 2013. So it's been going now for getting up towards 3.5 years. This may be a little bit of a false break, but then again, it could just be where I've got the line drawn at this point in time. And we did finish down towards 76. And look, all the fundamental drivers still pointing towards the Australian dollar lower and the US dollar higher. The ASX 200 didn't do very much on the week. As you can see, it was pretty much becalmed as well, and quite short trading ranges on each day. So not a lot of action there. So just to reiterate, the Australian dollar was down from its peak during the week to 76.3, but on a slightly bigger view, the combination of a lower US dollar and the improving signs for iron ore and for energy is holding our dollar up. So the index down by 4. The banks were really the drag on our index. The material stocks, BHP and Rio, certainly did better. If you want an example of not following the news and following prices, then BHP came out with an absolute shocker result and the share price went up. So the conclusion is it was already baked into the price, wasn't quite as bad as what people thought, and the market went up. Now, what we are seeing in Australia, though, is that buying sharp dips in really high quality trending stocks is paying some very good rewards, and we've seen some 10 and 20% gains in just a few days in some of our best stocks. If you are prepared, if you know what it is you want, you know what price roughly you want to pay for it, then there's been some very, very quick gains available in that market. Now, turning to precious metals, which of course I'm extremely bullish on. Gold was down $25 on the week, and that was at a time when the US dollar went down as well. So certainly a little bit of an unwinding of the rally in gold. Silver also slipped a bit further below $20. So certainly a bit of downside in the precious metals market, but that was way overdue. However, I still remain extremely bullish because the reaction from precious metal stocks was really very positive. There was some attempted intraday sell-offs, and with almost all stocks, they basically bounced and finished well off their lows, even though they may have finished net down on the day. And the stocks just continue to look highly resilient. Less so in Australia. The Australian gold stocks have certainly underperformed their American counterparts, that's for sure. So again, it comes back to basically, trading what you're seeing and trading the patterns as they appear, not what you think should be. Now, the second quarter financials for the American stocks have been out now for a little bit, and I've had an opportunity to go through certainly some of them, and it's just confirming the very large increases in margin that the precious metal stocks have been enjoying since the end of 2015. So the fundamentals are now starting to support the bull market and to support the valuations. A lot of people were looking at the historic or the trailing valuations on US gold stocks and saying they were at ridiculous PEs. There's a whole bunch of reasons for that, which I won't go into, but that's just the difference between the market looking backwards and the market looking forwards. Speculative longs in the futures market, as you know, is an issue for me. We're at pretty much close to record levels. It still presents a short-term risk because of the leverage involved. However, they haven't really come off very much yet. We may be seeing just a little bit of an unwinding at the moment, and that unwinding may continue a little bit further. But I see that as a correction presenting an excellent opportunity to start to build your exposure. But I really want to make this point really strongly, and this is typical of any new bull market. The easy money gets made at the start. When the sentiment shifts and people start piling in, it starts with the big stocks and then it filters down to the smaller stocks. And we've seen all that, and there's been a lot of spectacular rises, anywhere from 200% to 600%. So pretty much the rising tide of sentiment, has lifted nearly all the boats. However, that phase is now complete, and from here on in, the market is going to focus more on debt levels, on profit margin levels, sustainability levels, and so your focus really must be on quality stocks. And we're now going into the phase of the market where stocks that may have gone up a fair bit are now at a much greater risk than before. All right, let's take a look at precious metals before we get into energy. So we'll start with, first of all, the weekly chart for gold. And you can see we've basically been just in this sideways pattern now for 6 weeks. But it's still looking very positive, and we haven't had much of a pullback so far. Just zeroing in a little bit on the daily chart. There's the $25 drop on Friday night. But look, we're still really just in quite a tightening range there. Silver is still holding just above that key support and resistance level. It's getting down to be a little bit oversold now, and look, could even pull back a little bit further. But all the other signs are very positive. Let's look at the GDX index. We're still consolidating underneath this key resistance level around 31.5. So you can see gold down $25, but really GDX didn't move that much. Most of the major components were only down by around 1 or 1.5% in GDX. So that's a very mild response to a $25 fall in the price of gold. So everything continuing to look extremely positive in the precious metals market. Copper was steady at $2.16, but this is the market that I'm now looking to add. So don't get me wrong, I'm not moving away from the precious metals market at all. I still think there is just enormous upside in the precious metals market. But wherever we can, we should try and spread our risk. And if there's a new bull market starting in the energy sector, then we really should be a part of that as well. Crude oil moved higher to 48.50. We'll look at a chart of that in a minute. And there's definitely a shift in the balance between supply and demand around the world. Clearly, inventories are falling, which is one of the key things that had to happen. Demand is still rising, and rising at a reasonably healthy rate. Supply has been reduced, And so the fundamentals, I don't believe, I still think the balance point is going to be sometime in the second half of 2017. So we're still nearly a year away from supply and demand coming into balance. But you've got to remember that markets are forward-looking, and that's why I think we're starting to see a breakout in energy stocks, certainly in America. Now, the other reason as well that I've certainly turned more positive, apart from the charts, is that the speculative shorts in the oil market are basically at a 10-year high. So people are really betting that oil's going back down again, and I just love to be on the contrarian side of that sort of position. Now, we've also seen this very high speculative longs in the precious metals market, but I think there's a different set of dynamics going on there. Now, crude oil has held support at its 200-day moving average, which technically is a positive. We've got key resistance at $50. If we can break above there, then I think we're perhaps going to see a move higher in crude oil. But when we get down to the individual stocks, particularly some of the bigger stocks, we're seeing some really broad-based momentum building across the entire energy complex. And it's not just oil. We're seeing more positive momentum in gas and heating oil. So it's the whole energy complex. And as members of Specialist Share Education know, I've just started including some potential new trades in what I believe is now a new emerging bull market in energy stocks, and they're looking extremely positive. There's the 1-year chart for West Texas Intermediate crude oil. It's a little bit hard to read some of the figures on this. The dotted line at the top is $50, and you can see the market ran up to 50, it pulled back to 40, and now we're heading back up and having another crack at breaking through 50, which is obviously a key resistance. And if that level can break, then I think 75 is probably the next target over time. So to wrap it all up, identifying new bull markets early on is highly profitable. Now, those of you that have been following this bull market know that I certainly made a comment about the move in precious metal stocks in January of this year, but I didn't move on it until late February and into early March because I wanted confirmation, and I was prepared to give away the first part of a new bull market to have a greater level of confidence, if you like, that a new bull market was starting. And I think we're in the same position now in the energy sector. So we're just starting to get confirmation of those breakouts. But even more so than in the precious metals market, there is a massive variability in the financial health in the energy sector. If you're not well versed in being able to analyze companies and value companies, then just be very, very careful in this market, because there's an even bigger variability in financial health in the energy sector than there is in precious metals. So potentially a lot of pitfalls. Finally, and I've made a lot of this point last week because I was at the Australian Investors Association conference the week before that, so I was able to get a really good gauge on sentiment, on what people are thinking. And I just want to make the point again because it's so important. Don't be a sideline watcher. Over the last 5 or 6 years, I've been talking to lots of people that have remained on the sidelines because the media reports and the doom and gloom sayers have basically scared them into staying on the side of the market, and that's been hugely to their detriment. To me, the positive signs at the moment are really undeniable. US general stocks are in a new uptrend. We saw that in the S&P. We're seeing that in the rotation out of from defensive stocks into the more aggressive sectors of the market. We're seeing precious metals are unquestionably in a powerful new bull market. We've now got energy stocks looking as though they're joining in as well. So really, there is just so many reasons to be a part of the market. I just want to leave you with what I believe is the most important element, and this was the thing that I focused on last week, and I always focus on, and that's basically your psychology, because you can have the best strategy in the world, you can have the best recommendations and stock tips in the world. If you're not in control of your psychology, then you actually have nothing at all. So it's incredibly important, and this is a great quote from Jesse Livermore, one of the greatest traders that's ever lived. And he said, emotional control is the most essential factor in playing the market. Never lose control of your emotions when the market moves against you. Don't get overconfident when you win, and don't get too despondent when you lose. It's about having a coherent game plan, trading the medium to longer term, and just basically stacking the probabilities in your favour. So to finish off, my message is this: don't let psychology ruin your wealth. I see it in many people, and one of the things I say to those people is in 2009, where we were sitting with the way the fundamentals were sitting at the time, did you think in your wildest dreams that the S&P index would treble over the next 6 years? And the answer that anyone would give to that, including me, is of course not. That was inconceivable that the S&P would go up by 300% in 6 years. Yet it did. And so where we sit at the moment, despite what you might think, the markets are heading higher. It's undeniable. And so you really should stop being a sideline watcher if that's what you're doing, and get into the game and participate. So that's it for this week. As always, Special Share Education members are right in the thick of this, and they're making some good profits. For those that are not within the group and would like some assistance, there's my contact details. Always happy to talk with you, and let's see what the next week unfolds. Cheers.